Pullbacks are where smart traders enter, not breakouts. In this video, you'll learn 8 simple and effective ways to catch pullbacks with precision across any market. These techniques will help you avoid chasing price and start trading with confidence. Before we start, YouTube tells me that over 80% of you watching haven't subscribed yet. If you find value here, hit the like button and subscribe so you don't miss future videos. Now, let's get into it. Let me share something that could change the way you trade. Every market moves in 2 phases, impulsive moves and pullbacks. The impulsive move is where smart money makes money. The pullback is where most retail traders get trapped. Your success depends on spotting when the pullback is ending and the next strong move is beginning. In this video, I'll show you 10 powerful ways to catch pullbacks and trade with the smart money, not against it. The first way to catch a pullback is the break and retest technique. When the market is trending up, it means buyers are in control, so we're looking for buying opportunities. As price approaches a resistance level and then pulls back, that resistance becomes an important reference point. Once the market breaks above it and pulls back to retest it, that's where the pullback often ends and the next impulsive move begins. In the downtrend, it's the opposite. Sellers are in control. Price approaches a support level, bounces, and then comes back to break it. When it pulls back to retest that same support, now turned resistance, it becomes a key level where the next bearish move is likely to start. Let's look at an example in an uptrend. Here, the market is making higher highs and higher lows, a clear sign that buyers are in control. Price approaches a resistance level, pulls back slightly, then breaks above it with momentum. Now watch what happens. It comes back to retest the same level it just broke. That level, which was resistance, now acts as support. This retest gives us the perfect entry point. The pullback ends here and the next impulsive move begins, right in line with the trend. Now here's an example in a downtrend. Price is forming lower highs and lower lows, showing that sellers are in control. It approaches a support level, bounces briefly, then breaks through it. Later, price pulls back and retests that same level. But this time it acts as resistance. That retest is our signal. The pullback ends and a new impulsive bearish move begins. The second way to catch a pullback is using Fibonacci retracement levels. When the market makes a strong move in one direction, especially to the upside, many traders, including institutions, watch for a retracement to key Fibonacci levels like the 50% and 61.8%. These levels often act as support zones and offer great opportunities to re-enter the trend. Take a look at this example. The market made a clear impulsive move to the upside. Now, if we apply the Fibonacci retracement tool from the swing low to the swing high, we can see the 50% and 61.8% levels marked. As price pulls back, it finds support exactly at these levels. And look at what happens next. Price rejects the area and resumes the uptrend. This is a classic Fibonacci pullback entry. Now here's a downtrend example. The market drops strongly, forming a clean bearish leg. Using the Fibonacci tool from the swing high to the swing low, we identify the 50% and 61.8% retracement levels. Price pulls back into this zone, finds resistance, and then continues lower. Again, the Fibonacci levels acted as a magnet for the pullback, and a great spot for trend continuation. Now, here's an important tip. Fibonacci levels are powerful, but using them alone isn't enough to make a high probability trade. Always combine them with other factors like structure, candlestick patterns, or trend lines for stronger confirmation. That's how you turn a good setup into a great one. The third way to catch a pullback is by using the 20 and 50 simple moving averages. These moving averages act as dynamic support or resistance during trending markets. Let's take a look at this chart. As you can see, the market is clearly trending upwards. Each time price pulls back toward the 20 or 50 simple moving average, it gets rejected and continues higher. These moving averages are acting like a dynamic support zone, helping us identify where the pullback is likely to end and where the next impulsive move may begin. Now let's look at a downtrend. In this case, the 20 and 50 simple moving average are acting as dynamic resistance. Each time price pulls back into them, it gets rejected and continues to drop. This makes it easier to catch the end of the pullback and enter in the direction of the trend. Now remember, moving averages help identify where a pullback might end, but they shouldn't be used in isolation. Always look for confluence with structure, price action, or key levels. like we discussed in the previous strategies. That's how you improve accuracy and avoid false signals. Also, here's a quick warning. Moving averages work best in trending markets. In a ranging market, they become almost useless and even dangerous. Look at this chart. The market is moving sideways and price is constantly crossing above and below the moving averages. If you rely on the 20 or 50 simple moving average here, you'll get chopped up and possibly blow your account. But don't worry, keep watching because I'll show you exactly how to catch pullbacks in a ranging market later in this video. A fourth way to catch a pullback is by using a simple trend line. Let's take a look at this chart. Here, the market is clearly trending upward, forming higher highs and higher lows. We've drawn a trend line connecting the swing lows, and look what happens. Each time price pulls back to that trend line, it finds support and continues higher. That trend line becomes a reference point. It helps us spot where the pullback is likely to end and where the next impulsive move may begin. Now let's look at a downtrend example. Here, we connect the swing highs to draw a descending trend line. Each time price pulls back toward the line, it gets rejected and continues downward. This shows us where sellers are stepping back in, a clear sign that the pullback is ending and the next bearish leg is starting. Just like with moving averages, or Fibonacci levels, a trend line alone isn't enough. It becomes much more powerful when it lines up with other factors, like a key level, a candlestick pattern, or a Fibonacci retracement. The more confluence you have, the better your chances of catching a strong move. Strategy number 5 is a more advanced way of catching pullbacks, and it's all about understanding how smart money operates during distribution. Here's what happens. When the market is in an uptrend and reaches a high, smart money, big institutions, begin to scale out of their positions. But they can't sell everything at once, or they'd crash the market. So what do? They slow things down and create a range. This is what we call a distribution phase. A distribution phase is a period of equilibrium where buyers and sellers are temporarily balanced. Price moves sideways between a clear support and resistance level. But here's the trick. Before smart money sells off, they often create a liquidity sweep above resistance, a fake breakout designed to trap breakout traders and attract more buyers. After the liquidity sweep, price quickly reverses. Then, the market breaks below the support of the range, signaling that the distribution phase is ending and a downtrend is beginning. But here's the key to catching the pullback. After the breakdown, price often pulls back to retest the support level of the distribution range, which now acts as resistance. Take a look at this chart. The market was trending up, then slowed down and moved sideways. That's our distribution phase. Notice how price swept the resistance level, a classic liquidity trap. Then it broke down below support and shortly after pulled back to retest the bottom of the range. That retest is our signal. It marks the end of the pullback and the beginning of the new impulsive move to the downside. To use this method effectively, follow these 3 steps. Identify the distribution phase. Price moving sideways at a high, often after a strong uptrend. Spot the liquidity sweep, a fake breakout above the range to trap buyers. Wait for the breakdown and the pullback. Price breaks below support, then returns to retest it. That's your entry zone for the next move down. Strategy number 6 is the mirror opposite of what we just saw. This time, we're catching a pullback after an accumulation phase. When the market is in a downtrend and reaches a low, smart money looks to accumulate buy positions. But just like in distribution, they can't buy all at once. That would spike the market too early, so they slow down price and create a range. This sideways movement is what we call an accumulation phase. An accumulation phase is a period of balance where price trades between a well-defined support and resistance zone. It's where institutions quietly build long positions, waiting for the right moment to drive price higher. Before that move happens, we often see a liquidity sweep below support, a fake breakdown designed to trap sellers and activate stop losses from early buyers. So, what happens next? After the liquidity sweep, the market quickly reverses and breaks above the resistance of the range. That breakout marks the start of a new uptrend. But instead of chasing the breakout, smart traders wait for price to pull back to the top of the accumulation range, which now acts as support. This is where the pullback ends and the next impulsive move begins. Look at this chart. After a strong downtrend, price starts moving sideways. That's our accumulation phase. Then we see a liquidity sweep below support, a false breakdown that traps sellers. Shortly after, price breaks out above the range, then pulls back to retest the top of the accumulation zone. That retest is your low-risk entry point. It signals the end of the pullback and the beginning of the next bullish impulse. To trade this setup effectively, follow these 3 steps. Spot the accumulation range. Price moving sideways after a strong downtrend. Watch for the liquidity sweep below support. This confirms smart money activity. Wait for the breakout and pullback. The return to the top of the range is your ideal entry point for the next move up. Strategy number 7 for catching pullbacks is a more advanced but highly effective concept, the fair value gap. A fair value gap occurs when price moves aggressively in one direction, creating a small imbalance between buyers and sellers. On the chart, this shows up as a gap between 3 candles, specifically when the high of the first candle and the low of the third candle don't overlap. That space between the high of the first and the low of the third is what we call the fair value gap. It represents an area where price moved too fast for the market to maintain balance, and very often price will retrace back to that zone, almost like a magnet to fill the gap. This pullback into the fair value gap gives us a great opportunity to position ourselves for the next move. Take a look at this chart. The market pushed strongly to the upside, leaving behind a clean fair value gap. Price later pulled back into that zone, which had never been tested before, and reacted perfectly. This rejection gave us the signal that the pullback was likely over and that a new impulsive bullish move was beginning. Now, here's an example. In a downtrend, the market drops sharply, creating a bearish fair value gap. When price retraced into the gap for the first time, it faced immediate rejection, giving us a clear opportunity to enter in the direction of the trend and catch the next impulsive leg down. Not all fair value gaps are created equal, so here are a few key rules to follow if you want to use this technique effectively. For a fair value gap to be high probability, it should remain unmitigated, meaning it hasn't been touched or filled by price yet. Once a gap has been tested, its effectiveness drops significantly. If price has already retraced into it before, it's no longer reliable. When you see multiple fair value gaps in one move, give preference to the larger ones. Bigger gaps reflect stronger imbalances and are more likely to act as meaningful areas of support or resistance. If you have several fair value gaps of similar size, choose the ones closer to the origin of the move. These gaps, located in the lower part of an uptrend or the upper part of a downtrend, tend to work better because they're where smart money often initiates their positions. One last thing. Always watch how price reacts when it returns to the fair value gap. If price closes deep inside the gap or completely invalidates it by closing beyond the level, that's a red flag, and the setup may no longer be valid. You want to see a clean rejection, ideally with strong momentum, confirming the continuation of the trend. Now, let's move on to strategy number 8, and this one's a bit more advanced, the breaker block pullback. A breaker block is essentially a failed order block, but it turns into a valuable opportunity. Here's how it works. When an order block is expected to hold, but price breaks right through it, that same level flips and becomes a breaker block. Now, when price returns to retest it, that's your pullback, and that's your potential entry. Now, let me show you a chart example that brings everything together, all the criteria for a valid breaker block. We start with a clear swing high followed by a swing low. Then, the market makes a strong push upward, breaking and closing above the previous swing high. This move confirms a valid order block and signals strong bullish momentum. However, after sweeping the buy-side liquidity, price quickly reverses. This reversal marks a shift in sentiment, and the market forms a new higher high before starting to drop sharply. As the decline continues, price breaks and closes below the low of the last bearish candle, confirming a market structure shift to the downside. At this point, the bullish order block we identified earlier becomes a bearish breaker block. Now here's where the pullback comes in. After the structure break, price pulls back into the breaker block zone. This retest gives us the ideal entry point. Price pauses briefly, accumulating more buy orders, and then rejects the breaker block and continues the downward move with strong momentum. So there you have it. 8 powerful ways to catch pullbacks like a pro. If you found this video helpful, make sure to give it a thumbs up and subscribe for more trading strategies just like this. And if you want me to go deeper into any one of these techniques, let me know in the comments. I read every one. Thanks for watching, and I'll see you in the next video.